As the title of my title slide shows you, that pretty much sums up the market right now. I guess I would call it short and soggy rather than short and snappy, but that also pretty much sums up the market right now. This is a very weird market in a lot of ways, and I don't just mean that in the sense that the stuff I own isn't always going the way I'd like it to be going price-wise. It's just the interrelationships between markets, the way markets are trading against each other, it's very odd. And I think a lot of this is probably the impact of, extreme central bank liquidity measures. It's really distorted the markets quite a bit. I also think that liquidity is probably in the other direction. It's probably distorted the equities markets, at least the big equity markets, a little bit. It seems that there's a lot of valuation risk in New York. Things seem to be trading a lot higher than really makes a lot of sense. Certainly right now, I think Wall Street, I think it's fair to say they're getting a little bit edgy again, but certainly obviously from late December up until a couple of weeks ago, up until the last Fed meeting essentially, the start of the month, it was all about liquidity, the Fed put. Everyone was buying everything in sight. It isn't one of the charts, it's a chart I've shown in the issues before. It's not up in the deck that I've got today, but I sent, one of the things I sent out recently had a chart in it that's called sort of the dumb money and the smart money chart. And I don't really necessarily agree with the characterizations, to be honest with you, because the people that generate this chart, their characterization of smart money is institutional money and dumb money is retail money. In my experience, it's quite often the other way around. And frankly, the dumb money buying the S&P a month, 3 months ago or 4 months ago isn't looking that dumb at the moment. They're looking pretty smart. But it's interesting to note how much divergence there is there. The smart money, if you will, the institutional money, a lot of that money has been actually been exiting the market over the last 2 or 3 months. A lot of the latest rally, the December to May rally, if you will, in New York, a lot of that is retail. Like, it's very heavily retail driven. The other big driver for it is buybacks, companies themselves. That continues to be an extremely large factor in the major markets. In fact, there was a study that came out 4 or 5 months ago that showed that going back to basically the financial crisis, back to 2007, 2008, when you look at the net money flows, the amount of selling, the amount of buying, the amount of money coming into or out of the market as a whole, essentially corporate buybacks, and keep in mind a lot of these corporate stock buybacks are debt funded, represented essentially all of the net buying in New York in the last 10 years. All of it, 100% came from that. If you did not have those share buybacks, things would look a lot different than they do on Wall Street. In fact, it would look like a lot of the European and Asian exchanges, which obviously don't look nearly as good. So right now we've got this nice market in New York because of Fed dovishness. That's starting to cool a little bit. Things have been a lot less rosy, at least short term, on the base metal side. We all know why that is. I mean, there's been some slowdown in China, some slowdown in Europe. Those are, in fact, much more important markets for the base metal sector. The U.S., gets the headlines and writes the headlines. But in terms of the base metal side, it's not that important a market. China is obviously the 800-pound gorilla, but even the EU, for instance, is a much bigger user of base metals in general. It's a much more important swing demand area. But right now, a lot of this is sentiment driven, and you'll see a copper chart a little later in this. But you could replace a zinc chart, a nickel chart. They all basically look the same. There's been about a 10 or 15% drop in the last month and a half, and that's 100% sentiment based on the trade war stuff. I have no idea what Trump's going to do. Trump has no idea what Trump's going to do. Really, I mean, there's no point even pretending any of us has a clue what the guy's going to do tomorrow, much less in 3 months or a year. I think he's going to find, and I've mentioned this, I think, a couple of times to subscribers. I mean, as some of you probably know, my late wife was Cantonese. I was married into a Chinese family. And I think people in Washington making the assumption that because, and it's true, because the U.S.-China trade relationship is arguably more important to China than it is to the U.S., the simple math they use in Washington is that means China's going to cave in easily or cave in first. I would not make that assumption. I would absolutely not make that assumption. They're forgetting that you're dealing with hundreds of millions of people in a new middle class that are just as patriotic as Americans are, and they're pissed. They think they're getting dissed. And I'm not saying America doesn't have any arguments for what they're doing. Their intellectual property stuff is right, but that doesn't change the fact that I don't think China's just going to roll over. So I don't know how long this is going to drag out, but it could drag out for a while. I think we have to simply, assume that that's going to happen, and if things get fixed quickly, then it'll be a pleasant surprise. But I think we have to operate on the assumption that's going to drag out for a while, that he is in fact going to put 25% on all of the imports. It's better to make that assumption and trade based on that than to be too optimistic, I think. And again, here's, this goes back about 3 years on the S&P. One thing I'd point out is there's all of the media, it's all about, the great market, the big rally in New York, the big rally in New York, the big rally in New York. If you take a look at that chart, the truth of the matter is, even Wall Street has basically been trading in a range for a year and a half. It really hasn't gone anywhere. If you look at where the S&P is trading right now, it's essentially exactly where it was 18 months ago. Granted, there's been some pretty big twists and turns in between. To me, it looks like it's probably rolling over a little bit again. My expectation is we're probably going to see another move down here, unless, the one big question mark is if China and the States do come to some kind of an agreement quickly, then yeah, you might see another rally up and maybe another new high. But I think failing that, I'm working on the assumption we're going to see things drift lower. And part of the reason for that, this chart that you see here, there's two things in that chart. The red is just the S&P index, exactly the same index that you saw before. It looks a little different because this is what's called a perf chart. It's basically a performance chart rather than a strict hard measurement chart. It just goes back to zero being set at the start of the chart and just is it up or down since the start of the chart. The blue line is what's called the equal weight index. It's a value line index. It's the S&P 500, but instead of doing weighting by market cap, which is how the S&P 500 index is calculated, they just do an even weighting on the assumption that you buy an equal dollar amount of each of the 500 stocks. And the reason why they calculate this index is it's useful for getting a feel for market breadth, how broadly dissipated or how concentrated a rally or a drop is, like how much participation is there by the broader index. And if you look at this, you'll notice there's this growing divergence between the two, where the S&P 500 right now, it's sitting at, just going back to the beginning of 1918, or it's sitting at about a 10%, whereas the value line is about minus 10%. What that's telling you is that this is turning into a more and more concentrated rally. There's less and less participation. Right now, there's a relatively small number of companies, essentially they're all the big tech companies everybody knows. They're the ones basically doing the heavy lifting. So the entire market is really dependent on a fairly small number of companies doing well. And a couple of those, some of those tech companies are companies that are going to have more issues going forward if the trade war gets expanded, because a lot of those ones, you're dealing with companies where there is a lot of back and forth between Asia and the US. There's a lot of assembly in China. You look at a company like Apple, which hasn't been doing that great in the market. Part of the reason it hasn't is because of the trade war, because essentially all of the iPhones get built in China. China can inflict more pain on Apple than on a lot of other companies. And keep in mind, it's the US consumer and the US companies that are eating the tariffs. It's not the Chinese. So you slap 25% on an iPhone, it's going to hurt if you're Apple. And there's several of the other big tech companies that are in a similar position. So that's another one of the reasons why I'm expecting things to go a little bit south. Another chart here I think maybe it's more, to me, it's more important than the equity chart. I watch bond yields a lot, and there's a couple of reasons for that. One is, if, God willing, we ever start seeing negative yields again, that'll be really good for commodities, even better for gold, and specifically within commodities. That's the environment in which they behave the best. But the other reason is that in my experience, bond traders are actually a lot better at sniffing out changes in the future than the equity markets are. Generally speaking, when you're looking at how the markets view what growth is going to look like in 6 months or 12 months or 18 months, bond traders are just better at it than equity traders are. The bond market is usually right, so that's why I pay attention to bond yields. And what you're looking at here, this is just one of the most popular Treasury securities, 10-year Treasury. This is the yield. I mean, you can see that the yield really started moving down in November and then December, and it was dropping during those periods because the equity markets were dropping. That was driving money into the bond market. And of course, when people buy bonds, because of the way bonds are priced, the more bonds they buy, the lower the yields go. And then you saw a flip up and then another drop when the Fed turned tail in December and suddenly started getting dovish from being, they weren't really bearish before, they were neutral, but they went from neutral to dovish. And again, that drives demand for bonds because bond traders start thinking, well, if yields are going to drop, that means the price I can sell these at is going to go up. So you get more demand in the bond market. It dropped quite precipitously into April. We saw a bounce the end of April, and that was the Fed not promising to cut rates soon, which for some reason everyone on Wall Street thought they would. I don't know why they thought that, but they did. But you've seen it drop again, and if you look at the extreme right-hand side of the chart, this is a big drop. I mean, this is a big move for the 10-year, and this is something that has me a little bit concerned, and it's one of the reasons that my personal expectation is that I think there's decent odds we're going to see a recession start in the U.S. before the end of the year. Not a bad one, nothing really nasty, just garden variety recession. But that's not, that is definitely not on the table. It's not in the front mirror for anybody on Wall Street. Everybody just debunks this anywhere you look on Wall Street, but I'm seeing more and more evidence that I think it's going to happen. And the next chart I'm going to show you, this is a yield curve. This just calculates, it's just a curve drawn from what's the yield on the 6 months, on the year, on the 2-year, the 5-year. And the reason why people draw these yield curves and what's important, if you look at that big fat arrow I stuck in the front of it, the blue line that you can see there, that's what the yield curve looked like a year ago. That's what a normal yield curve looks like. As you go with the yield curve, yields rise. Isn't surprising. You want someone to buy a 10-year bond, they expect a higher interest rate than a 1-year bond or a 2-year bond because there's simply time risk involved and liquidity risk. So that's what a normal yield curve looks like. You look at the red and the blue lines. The red line is a month ago, the blue line is now. You can see how the middle of that curve is kind of sagged down, and that's what they call an inverted yield curve. It isn't a fully inverted yield curve right now, but it's mostly inverted. It starts inverting, which basically just means the longer dated yield is lower than the current short yield. It basically rolls over at about 9 to 12 months. That's where it starts inverting. And why is this important? Why am I making a point of putting this up? This next chart is a chart that's generated by the New York Fed, and this is a pretty long chart. This goes back to 1960. This one, and what they do is they've got what they call a recession probability indicator, and it's probability of recession in the next 12 months from whatever the date of the chart is. And you can see that it almost never goes right up to 60, 70, 80%. The normal high point on this chart, 20 or 25% is actually a fairly high reading for it, and they actually generate this based on the yield curve. The main input to this indicator is actually the yield on 10-year treasuries minus the yield on 3-month treasuries. And if you look at the right side of the chart right now, and the reading is up on the upper right-hand side, the current reading, and this is as of like yesterday, is 27%. That means in their estimation there's a 27% chance of a recession starting within 12 months. The thing to keep in mind about the way this chart works, if you look back, you can see the gray bars, those are recessions in the past. It rarely gets above 30 or 40%, even in a recession. There's a limit to how much things are going to invert, except in really weird periods. That really high spike that you see, that spike you see there, that's sort of that period where Volcker took rates up to 20% and choked off inflation. That's why you get this crazy, gigantic yield inversion there. But that's unusual. The percent we've got now, I don't think on this chart you will find, I think there was one period in the last 60 years where you got to 25% or above and there wasn't a recession within 12 months. So when it says the odds are 27%, reality that means the odds are probably 90%. It's extremely unlikely we won't see a recession in the U.S. by the end of the first quarter. Personally, I think it starts in the fourth quarter. Not trying to freak anybody out. I'm just telling you what I see. And the funny thing is that people still aren't, if you look at Wall Street, this is a VIX chart. This is another fairly long-term chart. VIX is just a risk measure. It's an instrument you can trade to essentially give your opinion on risk. I mean, when the volatility goes higher, it spikes. When it goes lower and things are calm, it drops. You can see it's generally a little bit higher in the last year and a half than it was for several years before that, but we're pretty much smack in the middle of the range right now. People aren't freaking out. People are not nervous on Wall Street. But, I think it's important to remember, and again, I'm not trying to be, Debbie Downer or Mr. Perma Bear, because I'm not a Perma Bear, but it's important to remember when you have a long cycle like this, the level of optimism tends to be highest towards the end of the cycle, or to put it in my own colloquial way, it's always brightest just before the shit hits the fan. So don't say, oh, things look good, so that means they can't look bad going forward. But the thing is, things generally look best in the market just before they get ugly. That's just how markets are. What does that mean for gold? And again, if you think back to the last chart, people really aren't that worried yet, because a common question I get, not surprisingly at these things, is why the hell isn't the gold price going up? It's because the market really isn't that worried yet. The risk, there isn't much risk aversion at all. You can see that in the bond market, you can see that in the equity markets. We've also had a situation where the US dollar has been fairly strong, partially because of weakness in the other major bloc currencies. I mean, the yen hasn't been doing much. I mean, obviously China's currency has been dropping because of the trade problems. Europe's got all kinds of its own problems economically, so the euro's been doing pretty bad too. Britain, Brexit, I mean, you name it. There's all kinds of things dragging down the competing currencies, which is strengthening the US dollar. I mean, if you look at the gold price in Canadian dollars and Australian dollars and a lot of producer currencies, it's actually doing fine. It's doing great in some of them, actually. It's near all-time highs in both the Canadian dollar and the Aussie dollar, which is good for the miners, but it doesn't help the market because the market totally focuses on the US dollar price. And personally, I think we got to see some US dollar weakness, or we've got to see New York roll over. And when I say New York roll over, I'm not saying we need to see a crash and everything going to hell in a handbasket. You don't want that. I mean, that situation, the liquidity basically vaporizes, and that doesn't help anybody. Just in terms of it being a bad market, or a falling, or basically just a market that's not pulling money in. It would also help in the case of our particular sector if we saw weed in particular roll over, because I have come around to agreeing with guys like John Kaiser that is sucking a lot of money out of our sector. It's one I think is destined to end extremely badly based on the valuations right now, but whether that starts in a month or 3 months or 3 years, I don't know. I don't think it'll be 3 years. It'll be sooner than that, but I think we've got to see that roll over as well. But in the short run, I think we need to see some major market equity weakness to up the risk aversion a little bit. That's probably the shortest route to a higher gold price. So, I mean, New York is still pretty bullish, although they're just getting a little slightly worried lately. Hard economic readings, and I didn't want to spend a huge amount of time on those in this talk, but you're seeing a lot of things drop off. A lot of the forward type readings, like bank lending surveys, actually the durable goods orders this morning, like just about everything in the last month or so has been going the wrong way. So I mean, I'm not imagining this. I mean, I'm telling you this based on actual statistics, and not survey statistics, but hard number statistics, because I tend to stick to those. If the Fed gets dovish again, and they might, I mean, Wall Street certainly wants them to cut rates. Trump wants them to cut rates. I'm not sure myself whether it makes a lot of sense for them to cut rates, but that doesn't mean they won't do it. The bond market is pricing in at least one rate cut this year, and certainly if they did that, if they surprised everybody with a rate cut next meeting, you'd probably see Wall Street rally again. But if they cut rates enough, it will get to the point where it is in fact going to help the gold price, because we're very close now to having negative rates. The only reason we don't have negative real rates is because inflation's gone nowhere. After 10 years of expansion, the inflation rate is still pretty much where it's been for 4 or 5 years in the US. I don't see any obvious reason to believe it's going to bounce higher. But if you get the interest rate cuts, that has the same impact. In terms, interest rate cuts and inflation going up have the same impact on real interest rates. And positive real interest rates or negative real interest rates is really what we want to see. That is the best environment for gold. And that may come if the Fed succumbs to pressure and cuts a couple of times, which is what everybody on Wall Street seems to want right now. I do think the U.S. is going to roll over. I think it'll be a very shallow recession, but it's going to be an interesting one, especially if the Fed succumbs to pressure, because I don't know what they do in that situation. Normally, historically, on average, the Fed would cut interest rates by 3% in order to buffer a recession, even a mild one. Well, given that the Fed fund rate right now is 1 3/4, then I don't know what the hell they do in a recession. I mean, they don't have any. They've got nothing to work with really, unless they're really going to turn on the taps again, which I don't think they want to do, and turn on the printing presses. But maybe that's all they've got. And I just want to touch on copper very briefly. I went through it already, but essentially, if you look at the end of this chart, I mean, some of this is just slowdown. Some of this is slowdown in Asia and Europe. This is tariffs, period, paragraph. That's the trade war. I'm not expecting to see it. I'm very positive on most base metals medium term, but short term, to get any kind of real bounce, we need, pure and simple, we need some kind of trade deal. It's not any more complicated than that. And this is a chart, and I know some of this stuff went up in the last block with Joe because he had a couple of the copper guys up. But if you look medium and long term, the supply demand looks really good on the copper side. And if anything, most of the news I've seen lately, and this is very typical for the mining sector, is things aren't getting permitted as fast as they thought. They aren't getting built as fast as they thought. I mean, Zambia announced a couple of days ago their production as a country, it's a big copper producer, would be 100 or 150,000 tons light this year. We may see something similar come out of Chile because a couple of things there are being a little bit slow. So if anything, the supply-demand balance in copper is improving. That obviously won't matter in the short term if we have a recession, but a lot of this stuff, 2 years, 3 years, 4 years out, looks like the market should be very strong for most base metals, especially copper. So it's definitely worth your while to be looking for development stories. You don't need to jump on them tomorrow necessarily, but there's definitely a window there for copper to move quite a bit. So essentially, I mean, it's pretty much the stuff I've talked about for the last couple of years. It hasn't really changed. It's a tough market to raise money in. It's not easy. Developers, the high margin, good jurisdiction ones, I think are still a good buy, but it's not. You don't have to rush out and buy anything tomorrow, especially since I do expect a mild recession towards the end of the year. Stink bids are the way to go with that stuff. I mean, there's no such thing as it can't get cheaper in the mining sector, let me tell you. I can tell you, having traded this stuff for 30 years, that it can always get cheaper. You may not think so, but it still happens. So, bidding rather than chasing is the way to go. There are stories that are in good jurisdictions, low capital intensity, low cash costs. We just saw Atlantic get in my opinion, a very good buyout price. I was very impressed. I think we'll see more of that, but it's got to be that type of deal where it's low cash costs, low capital intensity, where the company buying it's confident they can make margin right out of the gate. That's the stuff that gets bought. I think discovery stories still work. It's certainly not a coincidence that there's happened to be a couple of discovery stories at the table here right now because they're guys I invited, and they are getting attention. Discoveries, a really good discovery works in pretty much any market. Besides which, I just love the process of discovery, and I like following companies that are willing to go out and find new stuff. So that's the kind of company that I tend to gravitate to, those ones and the developers. And that's all I'm going to say for now. I'm going to move along since I'm, of course, already over time, as I often am. I'm going to invite